Welcome. Today we're diving into the essential skill every investor needs, analyzing a company's financial statements. Whether you're new to stock investing or looking to sharpen your approach, understanding these statements is key to making informed decisions. We'll break down the basics, explore what each statement reveals, and guide you through practical steps to evaluate a company's financial health. By the end, you'll feel more confident reading financial reports and spotting investment opportunity. Let's start by understanding why financial statements matter and how they fit into your investment strategy. Financial statements are the backbone of any company's reporting. They provide a transparent look at a business's performance, profitability, and stability. As an investor, analyzing these documents helps you assess risk, compare companies, and make smarter stock picks. It's not just about numbers, it's about understanding the story behind those numbers. By learning how to interpret financial statements, you gain an edge in identifying strong investments and avoiding potential pitfalls. Next, let's look at the three main types of financial statements you'll encounter. Every public company releases three primary financial statements: the balance sheet, the income statement, and the cash flow statement. Each serves a unique purpose. The balance sheet shows what a company owns and owes at a specific point in time. The income statement details revenues, expenses, and profits over a period. The cash flow statement tracks the movement of cash in and out of the business. Together, these documents provide a comprehensive view of a company's financial health. Let's start by exploring the balance sheet in detail. The balance sheet is a snapshot of a company's financial position at a specific date. It lists assets, liabilities, and shareholders' equity. Assets are what the company owns, like cash, inventory, and property. Liabilities are what it owes, such as loans and accounts payable. Shareholders' equity represents the owner's claim after debts are paid. The balance sheet follows the equation: assets equals liabilities plus equity. This statement helps investors gauge a company's stability and ability to meet its obligations. Next, we'll break down each section of the balance sheet. Assets are divided into current and non-current categories. Current assets include cash, accounts receivable, and inventory, resources expected to be used or converted to cash within a year. Non-current assets like property, equipment, and long-term investments provide value over a longer period. By analyzing these, investors can assess how easily a company can cover short-term obligations and how much it has invested for the future. Understanding the asset structure is crucial for evaluating liquidity and long-term growth potential. Liabilities are also split into current and long-term. Current liabilities are debts due within a year, like accounts payable and short-term loans. Long-term liabilities, such as bonds and mortgages, are obligations that extend beyond a year. Analyzing liabilities helps you understand a company's debt load and its ability to meet financial commitments. High short-term liabilities compared to current assets can signal liquidity issues, while manageable long-term debt can support growth. Next, let's look at shareholders' equity. Shareholders' equity represents the owner's residual interest in the company after all liabilities are paid. It includes common stock, retained earnings, and additional paid-in capital. A growing equity base often signals profitability and reinvestment in the business. Investors look at equity to gauge financial strength and long-term value creation. Comparing equity trends over time can reveal how well a company is managing profits and supporting shareholder value. Now let's move on to the income statement. Income statement, sometimes called the profit and loss statement, shows a company's revenues, expenses, and profits over a specific period. It answers the question: is the company making money? By analyzing this statement, investors can assess profitability, cost management, and growth trends. Key figures include total revenue, gross profit, operating income, and net income. Let's break down each section to see what they reveal about a company's performance. Revenue, often called the top line, is the total amount of money a company earns from sales before any expenses are deducted. It's a key indicator of business growth and market demand. Consistent revenue growth usually signals a healthy, expanding company. However, it's important to look beyond just the numbers. Consider the sources of revenue and whether growth is sustainable. Next, we'll look at how costs impact profitability. Cost of goods sold, or COGS, represents the direct costs of producing goods or services sold by the company. This includes materials, labor, and manufacturing expenses. Subtracting COGS from revenue gives you the gross profit. A lower COGS relative to revenue means higher profitability. Investors analyze COGS trends to assess efficiency and cost control. Let's move on to operating expenses and their impact on the bottom line. Operating expenses include costs not directly tied to production, such as salaries, rent, marketing, and research. These are necessary to run the business but can eat into profits if not managed well. By comparing operating expenses to revenue, investors can evaluate how efficiently a company is run. High operating expenses may signal inefficiency, while controlled costs can boost profitability. Next, let's look at operating income and what it tells us. Operating income, also known as operating profit, is calculated by subtracting operating expenses from gross profit. It reflects the profit generated from core business activities, excluding interest and taxes. A rising operating income suggests the company is managing its core operations well. Investors use this metric to compare companies in the same industry and to track performance over time. Now let's discuss net income, the bottom line. Net income is the final profit after all expenses, including interest and taxes, are deducted from total revenue. It's often referred to as the bottom line and is a key measure of a company's profitability. Investors look for consistent net income growth as a sign of a healthy business. However, it's important to analyze what's driving changes in net income. Are profits coming from core operations or one-time events? Next, let's explore the cash flow statement. Cash flow statement tracks the movement of cash in and out of a company over a period. It's divided into three sections: operating, investing, and financing activities. This statement helps investors understand how a company generates and uses cash, which is crucial for assessing liquidity and financial flexibility. Positive cash flow from operations is a good sign, while negative cash flow may indicate trouble. Let's break down each section of the cash flow statement. Operating cash flow shows the cash generated from a company's core business activities. It's calculated by adjusting net income for non-cash items and changes in working capital. Strong operating cash flow means the business can fund its operations and growth without relying on external financing. Investors look for positive and growing operating cash flow as a sign of a healthy business model. Next, let's look at investing cash flow. Investing cash flow reflects cash spent on or received from investments in assets like property, equipment, or securities. Negative investing cash flow isn't always bad. It often means the company is investing in growth. However, consistently large outflows without corresponding revenue growth can be a red flag. Investors analyze this section to understand how a company is allocating capital for future expansion. Now, let's discuss financing cash flow. Financing cash flow shows cash received from or paid to investors and creditors. This includes issuing or repurchasing stock, borrowing and repaying debt, and paying dividends. Positive financing cash flow can indicate new funding, while negative cash flow may mean debt repayment or dividend payments. Analyzing this section helps investors understand how a company funds its operations and returns value to shareholders. Next, let's look at how to use ratios for deeper analysis. Financial ratios are powerful tools for analyzing a company's performance and comparing it to peers. Ratios simplify complex data and highlight strengths and weaknesses. Common categories include profitability, liquidity, leverage, and efficiency ratios. By calculating and interpreting these ratios, investors can spot trends, assess risk, and make more informed decisions. Let's start with profitability ratios and what they reveal about a company's earnings power. Profitability ratios measure a company's ability to generate earnings relative to sales, assets, or equity. Key ratios include gross margin, operating margin, and net margin. These ratios help investors evaluate how efficiently a company turns revenue into profit. High profitability ratios often indicate strong management and competitive advantages. By comparing these ratios over time and against industry peers, you can assess whether a company's profitability is improving or declining. Next, let's look at liquidity ratios. Liquidity ratios assess a company's ability to meet short-term obligations. The most common are the current ratio and quick ratio. These ratios compare current assets to current liabilities, indicating whether the company can pay its bills as they come due. A ratio above 1 suggests good liquidity, while a low ratio may signal financial stress. Investors use liquidity ratios to evaluate risk and ensure a company isn't overextended. Next, let's discuss leverage ratio. Leverage ratios measure the extent of a company's debt relative to equity or assets. Common ratios include the debt-equity ratio and debt-to-assets ratio. High leverage can amplify returns but also increases risk, especially during downturns. Investors analyze leverage ratios to assess a company's financial risk and its ability to manage debt. Comparing leverage across companies and over time helps identify those with sustainable capital structures. Now, let's look at efficiency ratio. Efficiency ratios evaluate how well a company uses its assets and manages operations. Examples include inventory turnover and asset turnover ratios. High efficiency means the company is generating more sales per dollar of assets, which can lead to higher profits. Investors use these ratios to spot operational strengths and weaknesses. Tracking efficiency ratios over time can reveal improvements or emerging issues in management practices. Next, let's discuss the importance of trend analysis. Trend analysis involves comparing financial data over multiple periods to identify patterns and changes. By tracking key metrics like revenue, profit, and ratios over time, investors can spot growth trends, cyclical patterns, or warning signs. Trend analysis helps you understand whether a company's performance is improving, stable, or declining. It also provides context for interpreting current results. Next, let's look at how to compare companies within the same industry. Comparing a company's financials to industry peers provides valuable perspective. Industry averages and benchmarks help investors gauge whether a company is outperforming or lagging behind. Look at ratios, margins, and growth rates relative to competitors. This approach highlights strengths, weaknesses, and potential opportunities. It's important to compare similar-sized companies in the same sector for meaningful insights. Next, let's discuss red flags to watch for in financial statement. Warning signs in financial statements can signal trouble ahead. Watch for declining revenues, shrinking profit margins, rising debt, or negative cash flow. Unusual one-time gains or losses, frequent restatements, and aggressive accounting practices are also red flags. By staying alert to these issues, investors can avoid risky stocks and protect their portfolios. Next, let's talk about the importance of management discussion and analysis, MD&A. Management discussion and analysis, MD&A section provides context and explanations for the numbers in the financial statements. Here, management discusses business performance, risks, and future outlook. Investors should read this section carefully to understand the company's strategy, challenges, and plans for growth. MD&A can reveal insights not obvious from the numbers alone. Next, let's look at the role of footnotes in financial statement. Notes and disclosures provide important details about accounting policies, assumptions, and unusual transactions. They can explain significant changes in numbers or highlight potential risks. Investors should always review these notes to get a complete picture of the company's financial health. Sometimes the most critical information is found in the fine print. Next, let's discuss the importance of auditors' reports. Auditor's report provides an independent opinion on the accuracy and fairness of a company's financial statements. A clean, unqualified opinion means the statements are presented fairly. Qualified or adverse opinions may indicate problems or disagreements with management. Investors should check the auditor's report for any concerns or warnings. It's an essential step in verifying the reliability of financial information. Next, let's look at the impact of accounting method. Different accounting methods, such as accrual versus cash accounting, can affect how financial results are reported. Companies may also use different depreciation or inventory valuation methods. These choices impact reported profits, assets, and liabilities. Investors should understand which methods are used and how they compare to industry norms. This knowledge helps you interpret results accurately and avoid misleading conclusions. Next, let's discuss the importance of consistency in reporting. Consistency in accounting policies and reporting practices allows investors to compare results over time. Frequent changes in methods can make it hard to spot trends or assess performance. Investors should look for consistent reporting and be cautious if a company frequently changes its accounting approach. Consistency builds trust and makes analysis more meaningful. Next, let's explore the role of non-GAAP measures. Non-GAAP measures are alternative performance metrics reported by companies, such as adjusted earnings or EBITDA. These can provide useful insights but may exclude important costs or one-time items. Investors should use non-GAAP measures alongside standard financial metrics and understand what's included or excluded. Relying solely on non-GAAP numbers can be misleading. Next, let's discuss the importance of cash versus profit. Company can report profits but still face cash shortages if earnings are tied up in receivables or inventory. That's why analyzing both the income statement and cash flow statement is crucial. Cash flow reveals whether profits are actually turning into cash. Investors should look for strong cash generation to support dividends, debt repayment, and growth. Next, let's talk about the significance of free cash flow. Free cash flow is the cash left after a company pays for operating expenses and capital expenditures. It's a key indicator of financial flexibility and the ability to invest, pay dividends, or reduce debt. Investors favor companies with strong, growing free cash flow. This metric can also signal whether a company is generating enough cash to fund its future plans. Next, let's discuss the importance of return on equity (ROE). Return on equity measures how effectively a company uses shareholders' equity to generate profits. It's calculated by dividing net income by average equity. A high ROE indicates efficient use of capital and strong management performance. Investors compare ROE across companies and industries to identify leaders. However, extremely high ROE may result from excessive leverage, so it's important to look at the full picture. Next, let's look at earnings per share (EPS). Earnings per share, or EPS, is the portion of a company's profit allocated to each outstanding share of stock. It's a widely used indicator of profitability and is often reported in quarterly and annual results. Rising EPS usually signals growing profits and can drive stock prices higher. Investors should also consider whether EPS growth is driven by real earnings or share buybacks. Next, let's discuss the price-to-earnings (PE) ratio. PE ratio compares a company's stock price to its earnings per share. It's a popular valuation metric that shows how much investors are willing to pay for each dollar of earnings. A high PE may indicate high growth expectations, while a low PE could signal undervaluation or risk. Investors use the PE ratio to compare companies and assess whether a stock is fairly priced. Next, let's look at the price-to-book (PB) ratio. Price-to-book ratio compares a company's market value to its book value, or net assets. It's useful for evaluating asset-heavy businesses like banks or manufacturers. A PB below 1 may indicate undervaluation, while a high PB could signal overvaluation or strong intangible assets. Investors use this ratio to spot value opportunities and assess downside risk. Next, let's discuss dividend yield and its importance for income investors. Dividend yield measures the annual dividends paid per share as a percentage of the stock price. It's a key metric for income-focused investors. A high yield can be attractive, but it's important to check if dividends are sustainable. Investors should analyze payout ratios and cash flow to ensure the company can maintain or grow dividends. Next, let's look at the importance of understanding business model. Company's business model explains how it makes money and sustains growth. Understanding the model helps investors interpret financial results and assess long-term prospects. For example, subscription-based businesses may have recurring revenue, while manufacturers rely on product sales. Analyzing the business model alongside financial statements provides a fuller picture of risk and opportunity. Next, let's discuss the impact of economic cycle. Economic cycles, periods of growth and recession, affect company performance. Some businesses are more sensitive to economic changes than others. Investors should consider how companies' financials respond to different phases of the cycle. For example, consumer staples may be stable while luxury goods are more volatile. Understanding these dynamics helps you anticipate risks and opportunities. Next, let's look at the value of forward-looking statement. Forward-looking statements in financial reports discuss management's expectations for the future. These projections can provide valuable insight into growth plans, risks, and opportunities. However, they are not guarantees and can be influenced by many factors. Investors should use forward-looking statements as one piece of the puzzle, alongside historical data and industry trends. Next, let's discuss the importance of diversification in investing. No matter how thorough your analysis, investing always involves risk. Diversification, spreading investments across different companies and sectors, helps reduce the impact of any single loss. By analyzing financial statements from multiple companies, you can build a balanced portfolio that aligns with your goals and risk tolerance. Next, let's look at how to keep learning and improving your analysis skills. Financial analysis is a skill that improves with practice and ongoing education. Stay updated with new accounting standards, industry trends, and analytical techniques. Read annual reports, attend webinars, and learn from experienced investors. The more you analyze, the better you'll become at spotting opportunities and avoiding pitfalls. Next, let's summarize the key steps in financial statement analysis. Analyze a company's financial statements. Start by reviewing the balance sheet, income statement, and cash flow statement. Calculate key ratios, compare trends, and benchmark against industry peers. Don't forget to read footnotes, auditors' reports, and management commentary for deeper insights. Always consider the broader business model and economic context. By following these steps, you'll make more informed investment decisions. Finally, let's wrap up with some closing thought. Analyzing financial statements is a powerful way to understand a company's strengths, weaknesses, and future potential. With practice, you'll gain confidence in interpreting numbers and making investment choices. Remember, no single metric tells the whole story. Use a combination of tools and always keep learning. Stay curious, keep analyzing, and you'll be well on your way to becoming a successful investor. Thanks for joining this journey into financial statement analysis.